When we talk to folks in the ecosystem, whether they are active participants on the technology side, launching tokens, trying to manage a fund, investing in tokens, or otherwise have an interest, the question we hear over and over is, what does it take for institutional money to flow into the crypto ecosystem? And that's a complicated question, but there is a fairly easy and straightforward answer. It is quality projects. What is it about your project that makes it investable? It's liquidity and market cap. Is this space big enough to be investable? And it's institutional quality service providers in the ecosystem. If you're launching a token, that's very similar in some respects to launching a company or doing a startup. And in the traditional world, you wouldn't think about keeping the cash for your startup under your mattress. You'd go to a bank or some reliable financial institution to hold those resources. And when we look at ICOs and other participants who have crypto either on their balance sheet or in reserve, holding that in self-custody or some solution that isn't institutional in nature or isn't robust and doesn't have the right controls and infrastructure in place will lead to a lack of confidence in investors and in secondary markets. At DACC, we looked at that problem 18 months ago, saw that the crypto ecosystem was generally retail focused, and while really active and interesting, had yet to draw the institutional money that many of the players were hoping for as they launched more and more sophisticated projects, and as we started to experience the ICO bloom of early 2017. We looked at what it takes to attract and retain clients who have very high expectations, very specific needs, and are not satisfied with a retail offering. And we built DACC from the ground up, as we say, purpose-built for crypto custody based on several key principles. First, the best-in-class security, physical security, cybersecurity, et cetera, making sure that there is no reasonable way that these assets can be compromised. Second, with a view that the world is a multi-coin, multi-token world as we experience all sorts of interesting projects, large and small, investors and institutional players, whether they are fund managers or asset managers or high net worth individuals, they want to have a portfolio. They want the opportunity to invest in projects of various types. And so from the beginning, we built with a view toward a multi-blockchain, multi-token universe and an infrastructure that provides the right controls around that regardless of which blockchain. So, for example, implementing off-chain multi-sig for the tokens that don't support it or the chains that don't support it natively, making sure that that key fundamental protection is there, and building in processes and controls in the software to ensure that at least 4 people sign off on transactions and that minimum requirements are met for fundamental security. We built it with, thirdly, a team of service-oriented professionals. I think one of the challenges in fintech in a nascent space like crypto can be that firms get overwhelmed by the number of clients or issues that they're dealing with and don't provide the highest levels of service and support. And we've seen that over and over, that can be a struggle for the exchanges, for other participants to then satisfy the institutional client who demands a higher level of service. And fourth, we built it with a level of transparency. So when an institutional client wants to know what controls are in place, how do internal operations work, how do I know that my assets are safe, can I see the facility, can I point at the hardware that has my keys, we said, absolutely, yes, you can. We expect you to undertake a great deal of due diligence and care and make sure that what we are doing is exactly what we say we're doing. So all of that is a fundamental and foundational set of principles. We launched the business last year and have been actively serving clients in custody and look at the future, fintech and crypto, and some of the evolution coming as one where institutional players are going to take an increasingly active role. We're talking every day with large asset managers, large traditional exchanges, and other participants who are looking for ways to tokenize real-world assets, to get their operations onto a DLT backbone, and need institutional quality service providers across the board, not just custody, but in every respect. And we see a coming wave of both money flowing into the crypto space, but also finance in general becoming increasingly dependent on the principles and the tokens that are issued as part of blockchain, crypto, and/or DLT. The team we have that services clients, I think, is second to none. We come out of financial services backgrounds, prime brokerage, hedge funds, asset managers, asset servicers, and we often hear a question of, is the model in traditional finance the right model to be building crypto and the next generation of money on? Why centralize custody? Why imitate some of the traditional models? Why are the folks from a traditional background interesting? And while we have on our team a number of crypto enthusiasts and technologists who grew up in non-financial services, who are giving us a great technology edge and our ability to hold over 90 tokens and 10 different blockchains and do egress from cold storage in 15 minutes. The technology isn't always ready to support the innovation that's coming at scale today. And so starting with centralized custody is a way to bridge between now and a future that might have decentralized custody and decentralized exchanges as the status quo. But until that technology is robust and can handle transactions, hundreds of millions of transactions a second, it won't be able to underpin the backbone of the financial services. And some of the lessons learned in traditional finance help pave the way for the adoption of these new technologies, especially taking into mind the regulatory framework and ensuring that you are compliant and focused on keeping the regulators up to date and educated so that surprises don't happen later. I think one of the most interesting things we can do as fintech innovators and as an industry is to ensure that the regulators come along with us so that they don't try to catch up to us later in a way that's disruptive to our business models and/or destructive to the businesses that we build. In summary, we're really excited about where crypto is going, where DLT can offer great advantages to financial infrastructure, where tokens and the digitization of assets can take global monetary systems and financial trading and markets. We're excited about being able to apply some of the key building blocks of the traditional space in an innovative space, and to do it in a way that allows traditional managers to be involved. Any questions that I can take?
How would your client go about executing the trade?
So today, our clients are looking at egress to a whitelisted wallet or to an exchange where they're going to trade, or to an OTC broker. And that can come from a secure email, from our portal, or from our API. We're going to go through a set of checks. There's going to be at least 4 people signing off on that transaction. We're going to do a confirmation with an approver at the client. So an initiator and an approver as a segregated duties. And then our operators are going to affect the transaction, biometrically proving who they are, getting those assets off of the dedicated client hardware, and then broadcast to, or broadcast on the particular blockchain of reference, or otherwise to an exchange or OTC broker where they might be traded, or to that whitelisted wallet.
Any other questions before we let Doug go? Big round of applause for Doug and the DACC.
Thank you.